Hello, guys. Good morning, good afternoon, good evening. My name is Damola Michael Oladuni, and this is my YouTube channel, Mike Talk Finance, Business, and Investment. I'm that multi-billionaire profitable investor, fund manager, and I teach finance. And this is a platform where I impact lives and I impact the world. So, if you are just coming for the first time, you're welcome. We are grateful to have you here, and do well to watch our previous videos. It's going to be impactful. And we have been on a series because I trade the forex market also, and I want to teach people because I know a lot of people have questions about how this forex thing works. So this is what I'm teaching, and this is another series of my forex teaching. So we've started weeks back, so you should do it to watch this video so you can be up to date with the videos, with the knowledge you need, so you can continue from where we are. Okay, you can continue from where we are at the moment. So today we want to be discussing an interesting topic, which is candlestick analysis. Candlestick analysis. Last 2 weeks, if I'm not mistaken, we talk about the trend law for buy and the sell market. So you should watch it also to be updated. And today is candlestick analysis. So we have four things to discuss under this topic. What are candles, time frames, analysis of a candle, importance of analyzing a candle, importance of analyzing a candle. Then we'll go practical to go and see what exactly we're talking about under the live chat. That will be under the live chat. So that's going to be very, very, very important. And so I want you to fly with me without much further ado. Okay, so what is a candle? Now, in the forex market, let me get my pen. We have different kinds of charts. We have line charts, we have candle charts. So this is what I mean by it. For instance, now the market moved this way, the market moved this way. So this is a line chart. You can also have the market in form of candles, 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 like that. So you can see that the market actually went like this, came down, went up, and is coming down. So it can be either ways. So we have different kinds of charts, different kinds of chart. Now, permit me if you see me looking towards the left hand side of the screen, that's because I have a bigger screen that I use for trading. So that's what I'm actually looking at. Okay, so we have line chart, we have bar charts, and we also have candlestick charts. Those are the three types we have: line chart, bar chart, and candlestick chart. And I will do that in the live session, so the practical session, so you can see what is it that I am talking about. So that is what candles are. It's just like a box, like the normal candle you have. So we have something like this. It can be something like this. It can be like this. We have different kinds of candle. We have different kinds of candle. Different kinds. It just depends on how it eventually was forming at that period of time. We have different kind of candles. Different kinds. I mean, different kinds of candle. We have candle that also is just like this. Different kinds of candles. So it just depends on how the market was actually forming at that point in time. I want to make it a bit thicker. So it just depends on what the market was doing at that point in time. All right. So these are what candles are. And if you have any question before I proceed, I just want you to comment on the notification session so I can actually respond to you as fast as possible, so I can answer your question. Okay. So that is what candle are. That is what candle are. Or that is what candle is. We have different kinds of candles, but just an understanding of what candle is what I've just drawn on the whiteboard. So it represents something. A candle is a representation of an entire market movement in a period of time. An entire market movement in a period of time, say 30 minutes, say 5 minutes, 1 hour, 4 hour, 1 week, 1 month, maybe 1 year. It depends. So that is exactly what candle represent. It represent an entire movement of price within a particular period of time. So at that particular period of time, for instance, if it is 30 minutes, then it means after 30 minutes, another candle is going to form or start forming. So a candle formed in 30 minutes, a candle formed in 5 minutes, because we have different time frames. This is what will bring me to the second point, time frames. We have different time frames in the market, and each of these time frames in the market have their candles. So price was actually moving up and down within that period of time. So that formation led to what is called a candle or a candlestick, right? That's what it led to. So the entire movement of price within a period of time is candlestick. It's just important you have a knowledge of what is it we are talking about. This does not make you a profitable investor, forex trader, or cryptocurrency trader, or whatever you trade. But it's just an understanding to have a basic knowledge of what these stuffs are, so you can be able to impact someone later, and of course you can be able to use it to make a better trading decision. So that's why we are saying all this. So I'm going to go practical shortly, so we'll just have 2 more points to talk about, and the third point is actually very important to me, which is candlestick analysis. So I'm going to draw a candle and I'm going to explain it. I'm going to break it down so you have an understanding of what a candle is. So generally, for a bull market, generally that's just a general, people just use green color for a bull market, and red color for a bear market. If you don't know what a bull market or a bear market is, please watch our previous video. I've explained that for you. So I'm going to draw a blue candle, and I'm going to explain what it is. Then I'm also going to draw a red candle. Yeah, so these are the 2 candles I'm going to draw, and I'm going to break it down. So this is called high. Sorry for that. This is not what I want to do. Okay, right. Let me pick my red pen. Okay, so this is called I'm not drawing it well. Okay. Yeah, this is what I want to draw. So this is called high, and this is called shadow. This is called body. This is called low. I want you to get this. Now for this, I'll pick my green marker. Okay. This is called high. This is called low. This is called shadow. This is called shadow S. This is called body. Right? So this is exactly what it means. So now let me explain a little bit, step by step. So the high means this is the highest point the market got to, for instance, in 30 minutes. So in 30 minutes, the price was going like this. So this was the highest point. This point, like this. This is the high, and this point here is the low. I want you to get that. Now the entire formation of this led to what we have as this candle. The entire formation of this led to what we have as this candle. I don't know if you get my point. The entire formation led to what we have as this candle. So market formed this candle after 30 minutes. Okay, so that's for that part. So the low, I've explained the high, I've explained the low, I've shown the body. So in between here is called the body. This body we have here, that's what the body is called. Now the shadow is the movement of price from it formed the body, then it came back up and formed what they call a shadow, a weakness. Now for instance, this is what I mean. Price started like this, price came down and is now building back up. So price went up, it came down to form a weakness. It's called shadow or wicks. That's what it's called. So price was building up, forming strength, building the body. Then it eventually came down to form a weakness. So the price became weak and it started selling. Then later on, the market gained back strength, then it started buying. So it leaves us with what we call a weakness. For instance, now, it left us with what we call a weakness. So that's what we mean by weak. So I'll explain that part. I just wanted to get um, the labeling properly so you can be able to know exactly what that represents. All right. So I'll clean everything I've drawn, then I will draw a candlestick, just one candlestick, and I will explain how price moved in this candle. Okay. All right. So let me pick my marker. Right. So this is a candle. Let's draw a perfect candle. For instance, I'm sorry I didn't tell you that this is open. Sorry, I didn't add that to the definition. This is open and this is close. It means price open at this level and close at this level. So now let's start the explanation. When the market opened at 12:01, no, not 12:01, the market opened at 12:00, then it started 12:01, 12:02, 12:03 till 12:30. 12:30, for instance. Sorry for that. Sorry for that. Sorry for that, please. Okay, back to our session. Sorry for that. So the market opened 12 o'clock and the market closed 12:30. I mean, this is a 30 minutes chart, for instance. So this entire candle was what formed in 30 minutes. This whole entire candle was what formed in 30 minutes, right? Okay, so the market opened. Once the market opened, the price was at 0.00. That's what the price was, 0.00. Then immediately, remember, if the market is going up, the buyers are leading. Now, if the market is coming down, the sellers are leading, right? Okay, so if you've understood that concept, then we can now proceed. So the market started coming down. What this means is that the moment this market was coming down, it was actually red. It would be a red color. That means sellers started leading the market. So the market started coming down. So at a point in time, this market was this way. Now, this is where it's now becoming, just concentrate. I'm sure you get it. So at a point in time, this market was like this. Just look at me. At a point in time, this market was all in red color. It was all in red color because the sellers were actually leading the market. So at this point in time, let's say price started forming 0.00, then price started becoming, if it goes above is plus, if it goes below is negative. Just take that as an ideology. Then price became minus 0.01 minus 0.02 minus 0.03. Price was going down. That's what started happening. Then let's say at 12:09, buyers came in at 12:09. Buyers came in and they started pushing back the market up. This market is still going to be in red color. So at the point in time, it was in red color. So buyers started pushing the market up. They started pushing the market up. They started pushing the market up. And eventually, they took the market back to point zero. So this market became 0.00, again 0.00. So the market was like this, right? It was like this. It formed what is called a T shape. Now there's a candlestick pattern that is called a doji. It's called a doji. This is a dragonfly doji, but you don't need to pick that now. I'm going to explain it when we get to that stage. This is why you should keep watching the videos, because I'm going to be explaining, but not everything for today. So it left us with what is called a doji for now, right? Then at 12:11, for instance, at 12:11, the market decided to pick momentum. Then buyers came in. Immediately, this market changed to a bull market, because before it was completely in zero. Then the market was now like this. It started forming like this. Let me clean my screen so I can have a lot of space to explain better. So you just get my gist now. Just get my gist. Just get my gist. So this market became like this. This was the shadow that the market became like this, all the way to this height. This is the height we're talking about. The market became like this. So it was a complete selling market. So the market was there about 12:25. It was a bullish market. So people were buying, buying, buying. Then 12:26, buyers came low. Buyers reduced and sellers came with much momentum. They decided to pull the market down. So buyers decided to pull the market down. So at 12:26, the market now became like this. Like this, because sellers, no, sorry, what did I just say? Sellers at 12:26, which is this, sellers came in and started dragging the market down. So they dragged the market from this high. The market went to this high, right? The market went to this high. This is the high. Then sellers came in and dragged the market down to this low. They dragged the market down to this low, right? Remember I said any weakness forms a shadow. So the buyers came and dragged the market downward to this low. They dragged the market downward to this low. So we only have this formation now as a body and this formation, leaving us with what is called a shadow. So this is why we have this candle this way. This is why we have this candle this way. This is why we have the candle this way. So just an understanding. At a point in time, this market was this way, right? Weakness brought the market. Buyers took the market up. It came like this, right? Sellers took the market down. It came like this. Remember, anytime the market forms a weakness, it leaves us with a shadow. That's why we got this body here and this shadow. So watch it and I'll watch it again if you don't understand. Watch it and watch it again. The market only becomes a red candle when price come back to point zero, which is the opening price, right? And below the opening price, automatically the color change to red. But as long as price is still above 0.01, it's a green color. Even if sellers push the market down to this level, the candle was like this. It's still going to be a green color. till they pull it below zero, then it start becoming a red color. Buyers actually led in this market. So the price closed at what? At 12:30 a.m. The price closed at this level. That's why we have this as a close, this as the open, this as the lowest point in time price got to, and the highest point in time price got to within 30 minutes time frame. That is exactly what candlestick is. So it's important. Now, what is the importance? This gives you an ideology of what price is saying. This is the interaction between the forces of demand and supply, or you can say buyers and sell, or you can say bull and bear. It just depends on whatever you want to use. It just depends on whatever it is that you want to do. Demand and supply, buyers, sellers, bull and bear. So is the price is an interaction between the both of them. They are trying to pull the market up and down. That's what led to this formation of a zigzag pattern. Buyers pulled it, sellers pulled it down, buyers pulled it up, sellers pulled it down, buyers pulled it up, and at the end, buyers won. That's exactly what we mean by um, um, candlestick formation within a particular period of time. In this example, it was 30 minutes time frame. So this gives you an understanding. Okay, who is actually leading in this market? For instance, when you see a candlestick like this, for instance, let me clean out all this whole stuff so the chart can be a bit clearer. So when you see a candle like this, for instance, when you see a candle like this, for instance, or when you see a candle like this, for instance, or a candle like this, for instance, let me pick the red color so we have different examples. Okay, so when you see a candle like this, for instance, now I'll explain my point. For this now, it's important to you to understand that I think the shadows are almost of equal height, equal length. So it means that both buyers and sellers are strong. So I need to be careful in this market. I can't say it's going to be a buying market or a bearish market because both buyers and sellers are strong. So I need to be very patient. In this market, for instance, the buyers pull this market to this height, but sellers now pull the market down. I know the market still closed above 0.01. Buyers still led, but this market seems to me as though sellers are very strong because sellers pull the market from this height down to this level, giving us this little body. So it means sellers are in these markets. So I need to wait for the next candlestick to give me a confirmation that sellers are actually interested in moving this market down. So for this candle now, for this candle now, I see this candle as well. I know sellers pull this market down, but what I can see is that buyers are still very strong. So I think buyers are still in this market. They are not yet tired yet. So I want to wait for a confirmation of another candle to close as a bullish candle to give me a signal of entry that, young man, I should start looking for reasons to buy in this market because buyers are actually in this market, right? So another example is this. When you see a candle like this, you make you understand that, well, this market is a sell market because buyers pull this market down to this height. I mean, buyers pulled it to this height. Then sellers pulled it back below zero. They pull it to 0.00 and below 0.0, and they eventually change to a red color. So it's telling you that sellers are here. So you just wait for a confirmation of a sell candle before you start looking for reasons to sell. Now, for instance, this example now, sellers actually pull this market down to this level, but buyers was able to only pull this market back a little bit. This will tell you that yes, sellers are still in this market. I just want to wait for a confirmation. Or I don't think I need to close my trade now, my sell trade. I think sellers are still in this market. So this is an example. This is why it's important to understand candlestick analysis. So let's move to the practical session. That's going to be very, very short because we've actually um, explained ourselves already. So You can see my pen is actually not. So for instance now, you can see this is a candlestick that formed. This is a candlestick pattern here. These are all candles, sorry. These are all candles that you can see. They are all candles. Now, first of all, this is the time frame we talked about. So this is 15 minutes. Where my mouse is, this is 15 minutes. This is 1 hour, 4 hours, dailies, weekly, monthly, like that. Like that, we have different kind of candle time frame. Now, I talk about candles. Now, these are candles. These are line charts. You can see the line chart I talked about, and you can also see bar chart. Where's bar chart? You can see bar chart. This is an example of what bar chart is, but we prefer to use the candlestick because it gives us a perfect understanding of how to analyze the market. So you can see that certain candlestick form and the market picked a different direction at key levels. The market picked a different direction. The combination of different candles is also candlestick analysis. For instance, not today, let me not give that today so I don't confuse you. But for instance, let's look at this candle here. Let's look at this candle here. You can see the weakness is so large. And what eventually happened? Buyers picked the market up to this level. So sellers actually sold down to this level. But buyers came in after, let's say, about 3 hours and 30 minutes. Buyers just came in and pulled the market back up. And they pulled the market from negative to positive, and now it's buying, right? So this is an example. So time frame, candlestick, chart, different kinds of charts, settings, whatever have you talked about that is I've not shown practically. So basically, this is just it. So candlestick, time frame, the type of charts, and understanding the importance of candlestick and what it represents. Because when a candlestick forms, certain things start happening in the market, and that's what we are having here. All right, guys. So back to our whiteboard session. I believe I've been able to do justice to this. I try not to make my videos long, but eventually this will be long. So if you have any question, please like, comment. But if this video is of help to you, like, share, subscribe, and also make me understand that this video is of importance to you. And bless other people, invite other people to this channel. I told you we are going to get to 1 million. I guarantee you that. They collect those things that be where as though they were. So I'm telling you what is going to happen. All right, guys. Love you, and see you next week. Bye for now.